Do you think that you don't need to file an income tax return because your income is below the tax limit? You might want to think again. Because in 2026, your income is not the only thing the tax department looks at. In fact, you could have zero tax liability and still be required to file an ITR. That's because the Income Tax Act contains several financial triggers that can make filing mandatory, even if you don't owe any tax. And some of them might surprise you. Let's start with the biggest one. If you are a resident Indian and you own any foreign asset, filing an ITR is mandatory. That could be foreign stocks, overseas ETFs, property abroad, a foreign bank account, or even signing authority in an overseas account. Many people investing in US stocks through Indian platforms don't realize that this rule applies to them. The second trigger is foreign travel. If more than 2 lakh rupees was spent on foreign travel during the financial year, an ITR may become mandatory. The tax department is increasingly tracking high-value spending, and overseas travel is one of the indicators it looks at. Then comes TDS and TCS. If the total tax deducted or collected during the year exceeds 25,000 rupees or 50,000 in the case of senior citizens, you may have to file an ITR. This often affects people with fixed deposits, freelancers, consultants, and those earning interest income. Now let's talk about the bank transactions. If your total deposit in savings account exceeds 50 lakh rupees during the year, filing becomes mandatory. And if deposits in one or more current accounts crosses 1 crore rupees, that's another trigger. The idea is simple. Large financial transactions should be backed by a tax return. The next category is business and professional income. If you run a business and your turnover exceeds 60 lakh rupees, filing is mandatory. And if you are a doctor, lawyer, consultant, freelancer, architect, or any other professional with gross receipt above 10 lakh rupees, you must file an ITR. Do you notice something? These rules are based on the turnover and receipt, not profits. So even if your income isn't very high, the filing requirement may still apply. Now here's something that surprises almost everyone: electricity bills. If your annual electricity expenditure exceeds 1 lakh rupees, you may be required to file an ITR. Yes, your power bill can become a tax trigger. And finally, there's the most common situation. Many people assume that because deductions under Section 80C, 80D or other provisions reduce their taxable income to zero, they don't need to file. That's not always true. If your gross income before claiming deductions exceeds the basic exemption limit, filing still may be mandatory. And most importantly, claiming tax refunds. In fact, many people discover that the tax department owes them money only after filing their return. So here's the simple takeaway. Don't assume that low income automatically means no ITR. Check your bank transactions, check your travel spending, check your TDS. And if even one of those triggers applies to you, filing could be mandatory. Because when it comes to taxes, it's always better to spend 5 minutes checking them rather than spending months dealing with a notice later.